Welcome back to Stock Talk. Today we're jumping right into the Walt Disney Company's Q2 fiscal 2025 results. They dropped their report on May 7th.
That's right.
Our aim here is to really dig into those numbers, figure out what they mean for Disney's health right now, and maybe see where they're headed.
Exactly. We've got the report right here.
And hey, if you find this helpful, do us a favor, like, share, and subscribe. It helps us keep doing these deep dives.
Definitely appreciate that. So looking at the big picture first, overall revenue up 7% year over year, came in at $23.6 billion.
Okay, 7% growth. Solid start. But what about the profits? That's where the real story often is, right?
Absolutely. And it's quite a story this quarter. Total segment operating income jumped 15%. That's up to $4.4 billion.
15%. Nice. And the earnings per share. I heard there's a big swing there.
Huge swing. Diluted EPS. Well, it went from a loss last year. Remember that tiny behind, a 1 cent loss?
Yeah, I do.
Now it's a profit of $1.81 per share. Dramatic improvement.
Wow. Okay. And the adjusted figure, the one that smooths things out a bit.
Adjusted EPS, yeah. That was also strong. Up 20%, landing at $1.45. So really healthy operational performance showing through.
That's a significant turnaround. Does the cash flow back that up? Or is it just accounting profit?
Look, the cash flow is maybe even more impressive. Cash from operations surged 84% to $6.8 billion.
84%.
Yeah. And free cash flow, the cash left after they pay for investments that more than doubled, hit $4.9 billion.
Okay, that's serious cash generation. Gives them a lot of flexibility.
It really does. And they put some of it to work right away, buying back $1 billion worth of their own stock this quarter.
Right, returning value to shareholders. Okay, let's break it down by segment. Where did this strength come from? How about entertainment first? That's a big one.
Yeah, entertainment was a major powerhouse this quarter. Operating income there shot up 61%. 61%, hit $1.3 billion. And that was on revenue growth of 9% to $10.7 billion.
So income grew much faster than revenue. What drove that?
A big piece of that puzzle is the direct-to-consumer business, streaming.
Ah, yes, the streaming story. Always interesting how they do.
Well, they actually made money. Operating income for DTC was $336 million. Compare that to just $47 million last year.
That's a huge jump towards profitability. It seems like those investments are finally paying off.
It certainly looks that way.
Okay.
And another boost came from content sales and licensing. That division went from losing money to making $153 million in operating income.
Okay, so entertainment looks really strong, especially streaming. What about sports, ESPN and the like?
Sports is a bit more mixed. Revenue was up 5% to $4.5 billion, but operating income actually went down.
Down? How much?
Dropped 12% down to $687 million.
Why the dip despite higher revenue? Costs.
Exactly. Higher programming and production costs. The report specifically called out having 3 extra college football playoff games this quarter compared to last year, plus an additional NFL game.
Yeah.
Those things aren't cheap.
Right. Big ticket sports rights. Any bright spots within sports, though?
There was one, yeah. Domestic ESPN advertising revenue. That jumped an impressive 29%.
29%. Okay, so advertisers are still really valuing ESPN domestically, even with those higher costs? That's something.
Definitely a positive counterpoint. Shows the platform still has serious pull.
Good to know. Okay, let's move to the segment people often connect with most directly, experiences. Parks, resorts, cruises.
Experiences continued to be, well, really strong. Operating income up 9% to $2.5 billion. Revenue climbed 6% to $8.9 billion.
And within that, how did the domestic parks do? The U.S. ones?
That was the real star. Domestic parks and experiences saw operating income surge 13%, reaching $1.8 billion. Just shows the enduring magic, I guess.
13% is impressive. What's fueling that? More people visiting, spending more.
It's both, really. Higher volume, so more attendance, more hotel nights booked, more Disney Vacation Club sales. And on top of that, guests are spending more per visit.
So price increases working or people just buying more stuff?
Probably a bit of both. Strategic pricing, plus guests choosing maybe more premium things. We also saw the new ship, the Disney Treasure, contributing more cruise days.
Makes sense. What about the other parts of experiences? Consumer products, international park?
Consumer products did well. Operating income up 14% to $443 million. Mostly driven by licensing. They mentioned the game Marvel Rivals, helping out there.
Okay.
But international parks had a tougher time. Operating income actually fell 23%.
Oh, why was that?
Lower attendance, particularly in Shanghai and Hong Kong. Plus, costs were up over there as well.
So a bit of a drag from the international side, but offset by the very strong domestic performance.
Got it. Let's circle back quickly to direct-to-consumer, the streaming side. We know income improved, but what about subscriber counts?
Right, the sub numbers. So Disney Plus ended the quarter at 126.0 million globally. Hulu's at 54.7 million, and ESPN Plus is at 24.1 million.
Any significant adds or drops there? Disney Plus and Hulu both saw modest increases. ESPN Plus dipped slightly. But importantly, if you combine Disney Plus and Hulu subs, the total is 180.7 million. So the overall footprint did grow.
Okay. And are they making more money per subscriber? That ARPU number.
Mostly, yes. The average revenue per user went up for Disney Plus domestically and internationally. It also went up for the Hulu Live TV bundle and for ESPN Plus Wrong.
But not everywhere.
The only slight dip was in the Hulu SVOD only plan. There's a small decrease there. And looking ahead, their guidance for Q3 suggests they aren't chasing massive subscriber growth for Disney Plus right now.
Focusing more on profitability, perhaps.
Seems that way. They're guiding for just a modest increase in Disney Plus subs next quarter. Sounds like sustainable, profitable growth is the name of the game.
Makes sense in today's streaming world. Okay, let's talk outlook. What did Disney say about the rest of the fiscal year 2025?
They put out some pretty positive guidance. For the full year, they're now targeting adjusted EPS around $5.75. That's a big step up.
$5.75 suggested. Okay. What about cash flow?
They raised their outlook there too, expecting about $17 billion in cash from operations now.
And the segments, what kind of growth are they projecting?
For segment operating income, they're looking for double-digit percentage growth in entertainment, around 18% growth for sports.
18% for sports, even with the cost pressures. Interesting.
Yeah. And for experiences, they're projecting 6 to 8% growth for the full year. So still confident across the board, really.
Those are strong targets. Did they flag any specific headwinds or investments we should be aware of?
They did mention a couple of things, about $200 million in pre-opening costs for the new cruise ships coming online.
Okay, expected for expansion.
And also an equity loss of around $300 million related to their joint venture in India. That's factored in.
Right, the India situation. And strategically, what's CEO Bob Iger emphasizing?
He highlighted a few key priorities. The upcoming movie slate, which they seem pretty optimistic about. The big one, launching ESPN as a standalone streaming service.
That'll be huge.
Definitely one to watch. Plus, ongoing expansions in the parks and resorts, and sticking to their plan of buying back $3 billion in shares for the whole year.
Okay, so clear priorities. Movies, ESPN streaming, parks, and shareholder returns. Now, balancing that, what are the key risks and opportunities investors should consider? Just a quick summary.
Sure, opportunities are pretty clear. That ESPN DTC launch, potential movie hits, parks expansion, improving streaming profits, and the share buybacks. All potentially positive.
And the risks?
Well, the usual suspect. Macroeconomic uncertainty. Could people pull back spending? Then there are the specific challenges in international parks we saw, those rising sports costs, the general shift away from linear TV, and that India JV impact.
A good checklist of things to keep an eye on. So wrapping this all up, what are the main takeaways from this Q2 report?
I think the big story is definitely the strong overall performance, really powered by that turnaround in streaming profitability within entertainment and the continued impressive results from domestic parks.
And the cash flow improvement seems critical too.
Absolutely. Much stronger free cash flow, and they seem disciplined about how they're using it. It suggests their big strategic moves are starting to deliver financially.
But not without areas to monitor closely, as you mentioned.
Exactly. Sports profitability is key. International parks need watching. How they navigate the decline of linear TV, those cruise line costs, and the India JV. All important factors for the next few quarters.
So it sounds like Disney is executing well in key areas, showing good growth, especially with streaming getting profitable and parks booming. But they're still navigating a pretty complex landscape.
That sums it up nicely, I think.
Yeah.
Real progress, clear strategy, but definitely still challenges and dynamics to manage. Overall, though, the outlook seems pretty optimistic from their perspective.
Well, this has been a great deep dive into Disney's latest quarter. Thanks so much for breaking it all down.
Always a pleasure.
And for you listening, here's something to think about. As Disney pushes hard into streaming with things like the ESPN DTC launch, how will that ultimately coexist with, or maybe even change, their traditional TV channels like ESPN itself? What does that balance look like long-term for their content and their bottom line? Something to ponder.